Silver crash warning, reading the signals and exit strategy. Stop everything you're doing right now, because what I'm about to show you is going to sound like a complete contradiction. A former JP Morgan strategist just went public warning that silver will crash 50% from current prices down to $55 per ounce. He's not hedging. He's not saying maybe. He's saying it's coming. But here's what they're not telling you. While this insider is screaming that silver will crash, JP Morgan, the actual bank, is doing something completely different. They're taking delivery of physical silver in the largest quantities ever documented. By the end of this video, you'll understand the 3 technical signals that have marked every major silver crash, the 8 warning signs that tell you when the top is forming, and the exact exit strategy to protect your gains. This is Tuesday, January 27th, 2026. Let's expose what's really happening. Section 1. The warning and what's really happening. Marko Kolanovic. The warning. Marko Kolanovic was JP Morgan's chief market strategist for over a decade. On January 27, 2026, he issued a bombshell. Silver will crash 50%. Rally is speculative mania. Target, $55 by second half of 2026. But here's the critical detail. He no longer works for JP Morgan. His views do not represent the bank's official position, JP Morgan's actual forecast. Greg Shearer, the current head of precious metals strategy, released the official forecast. Silver will average $56 in 2026, rising toward $58 by Q4. Not calling for a crash. What JP Morgan is actually doing. According to January 2026 CME data, JP Morgan stood for massive physical delivery. Over 1,000 contracts in a single day. 5 million ounces in one day. Total holdings, approximately 750 million ounces. That's more than a full year of global mine production. They went from the largest short position pre-2019 to accumulating 750 million ounces. That's a complete strategic reversal. Question. If JP Morgan believes silver would crash 50%, would they be sitting on $80 plus billion worth of it? Section 2. The 3 historical crash signals. Let me show you the 3 signals that have marked major silver crashes in history. All 3 just fired. Signal number 1. CME margin hikes. 1980. The Hunt brothers. Silver ran from $6 to $50. CME implemented Silver Rule 7 inches. Silver crashed from $50 to $10 in weeks. 2011. Post-financial crisis, silver ran from $8 to nearly $50. CME raised margins 5 times in 9 days. Silver crashed from $50 to below $30. 2026, right now. Silver ran from $30 to $117. CME raised margins 47%, from $22,000 to $32,500. Silver dropped 12% in 90 minutes on January 27th. When margins increase, leveraged traders must add cash immediately or close positions. Most sell. This creates a liquidation cascade. Signal number 2. Parabolic price moves. Silver up 270% in 12 months is parabolic. Everyone is on the same side of the trade. Positioning becomes extremely crowded. Any reversal triggers mass panic. Signal number 3. Multi-decade technical resistance. From 1996 to 2014, silver traded in a descending channel with a key trend line. In 2008, silver touched this line at $8 and bounced 462% to $45. On January 27, 2026, silver touched this same line at $117 from below. This time, it's resistance. The floor became the ceiling. Silver got violently rejected, dropping from $117 to $103 in 90 minutes. History says a correction is likely, but here's why this time might be different. Section 3. Why the fundamentals are unprecedented. While all 3 crash signals fired, there are factors that have never existed before. The China export ban, January 1, 2026. China reclassified silver as a, quote, strategic dual-use metal. You cannot export silver from China without explicit government approval. Only 44 companies have licenses. This did not exist in 1980 or 2011. The physical versus paper divorce. January 1, 2026. COMEX paper price, $72 per rose. Physical Japan, $130 per rose, 80% premium. Shanghai, $8 to $12 premium. Kuwait, $160 per rose. These are different markets in different realities. The inventory collapse. COMEX registered inventories collapsed 70% since 2020. Between early and mid-January 2026, 33.45 million ounces were withdrawn, 26% of inventory in 1 week. The structural demand, industrial demand 2025. 1.2 billion ounces. Mine production, 850 million ounce per year, flat. Annual deficit, 350 million ounces. Solar panels, EVs, AI data centers, all growing demand. The $17 billion Fed injection. The NY Fed delivered $17 billion emergency cash to an unnamed bank on December 26th. Rumor: margin stress on silver short position. This is not normal. This is crisis intervention. The fundamentals today are the strongest in silver market history. Yet technical signals say correction likely. This tension is critical to understand. Section 4. The 8 warning signs of the top. Here's what most people miss. We are not at the top yet, but you need to know the 8 signs that tell you when the peak is forming. Sign number 1. Retail mania. Current, January 2026. U.S. Mint sales approximately 75,000 ounces per day. Peak mania, 5+ million ounce per month. Lines at dealers, $20 to $30 premiums. Social media flooded. When your neighbors who never invested are buying silver, that's the top. Sign number 2. Mainstream media capitulation. Current, media covers silver cautiously. Peak, CNBC, Bloomberg, WSJ, all unanimously bullish, obvious, risk-free investment. When skeptics disappear and media promotes silver, easy money is made. Top is near. Sign number 3. Speculative futures at extremes. Current, net long positions elevated but not extreme. Peak, 80,000 to 100,000 contracts. When everyone who wants to buy has bought, only direction is down. Sign number 4. Industrial users step back. Current, companies scrambling to secure supply. Peak, at $150, $200. Industrial demand weakens, projects cut, substitutes found. Less industrial buying equals rally overstretched. Sign number 5. New supply coming online. Watch for headlines about major mines in Mexico, Peru, Canada, Australia beginning production. Supply deficit shrinks. Prices lose momentum. Sign number 6. Government intervention. At extreme highs causing economic disruption. Strategic reserves released. Export restrictions lifted. Can't control markets forever, but triggers volatility. Sign number 7. Technical breakdowns. RSI over 90. Parabolic move reversal. 15 to 20% drop in days. Confirmation that peak is forming. Sign number 8. Extreme euphoria. Everyone predicts $300, $500 plus. Skeptics gone. FOMO at peak. Market exhausted. Right now in January 2026? Maybe 2 to 3 signs present. We're not there yet, but you need to monitor these weekly. Section 5. The 5 TRAN CHE exit strategy. Once warning signs accumulate, you don't dump everything at once. You scale out systematically. Tranche 1, 20%. Silver breaks $100 with 3 signs present. Lock in profits while keeping exposure to further gains. Tranche 2, 20%. Silver hits $125 with 5 signs present. Total sold, 40%. Still capturing upside. Tranche 3, 20%. Silver reaches $150 with 7 signs present. Total sold, 60%. Majority of gains secured. Tranche 4, 20%. All 8 signs flash regardless of price. Total sold, 80%. Small position retained for potential parabolic spike. Tranche 5, 20%. Technical breakdown occurs. When silver plunges 15 to 20% in days, exit completely. What to do with proceeds? Cash/short-term treasuries, safest. Diversify into gold, real estate, commodities. Contrarian play. Rotate into undervalued assets. Most aggressive. Wait for post-peak drop. Reaccumulate at lower prices. Historical lessons. 1,980. Silver hit $50. Those expecting $100 watched it fall to $5 over decades. 2011. Silver peaked at $49, crashed to $26. Without a plan, gains evaporate. Opportunity costs accumulate. Action items now. Set up exit infrastructure. No dealers, IRA rules, fees. Track holdings in spreadsheet. Divide into tranches. Monitor warning signs weekly. Practice selling small amounts to familiarize yourself. You'll feel regret when prices rise after selling. Accept it. It's the cost of discipline. Section 6. The 2026 Roadmap. Here's the projected timeline based on current data and historical patterns. Stage 1. January to March. Accumulation. Smart money buying. Industrial demand surges. Retail interest grows but not manic. Expected range, $75 to $110. Stage 2. April to June. Mainstream adoption. Media coverage turns positive. Retail floods in. Early warning signs appear. 3 to 4 signs. Sentiment shifts. Expected range, $110 to $150. Stage 3. July to Sept. Parabolic phase. Silver goes vertical. $150 to $175 plus. All warning signs flash. 7-8 signs. Execute tranches 3 and 4. This is the danger zone. Stage 4, October to December. Peak and crash. Silver tops $160 to $200, depending on mania intensity. Technical breakdown occurs. 30 to 50% drops in weeks. Exit fully. Tranche 5. Stage 5 to 2027. Normalization. Prices retreat. Sentiment collapses. Weak hands shaken out. Patient investors wait for next accumulation phase. The fundamentals are still bullish. Technicals are supportive. This is not the time to sell, but prepare for the exit. Monitor the signs. Stick to the tranches. Silver may reach $150 or higher, but the bull market will end. Without a plan, you risk giving it all back. Conclusion. Actions versus words. So when will silver crash? The 3 historical crash signals just fired. Margin hike, 47%. Parabolic move, 270% in 12 months. 30-year technical resistance hit. This makes a correction likely near term. But the fundamentals are unprecedented. China export ban, 350 ounce annual deficit. Physical versus paper divorce. JP Morgan accumulating 750 ounces. Short term, technicals might win, volatility expected. Long term, fundamentals win, higher prices likely. The warning from the former strategist is designed to shake you out before January 31st contract expiration. JP Morgan's accumulation tells you what smart money believes. Monitor the 8 warning signs. Execute the 5-tranche exit when they align. Follow the money, not the noise.